So what we're going to do is we're going to answer these questions, but we're going to look at, in order to answer it, we're going to look at our first-tier liquidity provider feedback around this subject, along with, obviously, then we'll look at gold support levels as well, which is, of course, following the usual bid-pulling session after non-farm payroll. So we always got some volatility. So to answer the question, yes, the footprints were pretty darn clear. When we recorded that, silver was evidencing strong Chinese, Asian demand, but it was at $33. But with supply shortages, hard to hide, impossible to hide. And just about every single bullion bank long silver for their own books, which we've been tracking for a long time now, we actually had the ingredients for a rally into the season. So much so, it turns out the banks have actually front-run the July season by a full month. Normally we see silver strong in July. So perhaps a quick look at the charts would actually be helpful at this stage. So just to make a note, this is being recorded on Wednesday. We've just had CPI, the CPI print, and so this will be released on Friday. So just be aware that that is the time we're recording this. And it's really more important to look at the general direction and what we're expecting. That the bullion bank cartel was planning to short cover ahead of season was on the first trading day of June, which was here. And where spot silver took out the next round number. If you remember, we've been consolidating, and when we were talking about, in our last episode, we were talking about the 33 spot level. These are futures charts, so there was slight adjustments because of the contango between futures and spot. But essentially, on the first day of June, suddenly the 34 spot level, which is approximately $34.08 in futures. And not only did it blow through, and it immediately has now become support. So I didn't even get down to testing it before it was front run. Normally we see a pullback, So essentially that is where we first saw. Then once again, now last Thursday was interesting. This is really when silver's mispriced 14-year underperformance breached the large resistance at $35. We saw the $35 and actually hard testing and really triggering short stops at $36. Now, the contango expands a little to 12 cents at that price, and it will, in fact, expands a little bit more to 14 cents when we get up towards 37. But essentially, this is what we were looking at. And guess who was on the short side? It was actually the siloed speculators here and here that got royally rinsed. And what we've evidenced is really this inflection point. We're talking about the cartel having repatriated sufficient bullion. Collectively, they've allowed silver to decisively break out of a 14-year capped range. And so really, when you think about it, we're now dealing with a 14-year capped range. In fact, on Thursday, silver futures went bid only, forcing a massive short squeeze upon sleeping specs who'd become acclimatized to selling billions of dollars of bets against silver rising out of this 14-year capped range. Now, as we know, and we've done in episodes about this before, it's the highly leveraged options traders that get carried out feet first. Because when the leveraged cash bets they have made against whatever the asset class is, but in this case it's billions of dollars of paper bets against physical silver, and the market can suddenly go bid only, and losses to buy back these naked short bets can far exceed enough cash reserves to close these bets. In other words, it can bankrupt the short seller. Most people think of options as buying options. Now we're talking about aggressive selling options in the hope that it will come back down. And it has worked well for them. But when it goes bid only, look at what happens. Now we're in the process of seeing the first two signs of going bid only. Now, given there are several naked short CTA structures, commodity trading advisor structures still vulnerable for margin calls, we may see some further bid-only setups developing. Now, while these speculator bets are little more than collateral damage around what is really a multi-year Fed-held FX bets against silver, and we talked about the OCC FX bets, which are largely in the Fed's hands, and they can, obviously, because the Fed's controlling them, they can be cash settled by way of a series of keystroke entries, much as we saw when that happened after the Shanghai Futures Exchange. The short sellers wrong-footed, and really then we saw this sequential series of higher stair steps evolve. Similar action in silver. And what that's going to do is these when these bets are settled, even though they're cash settled, it's going to force much, much higher prices. Now, while the headline data evidences the silver cartel is now building one of the largest ever short positions against a race by speculators to now chase a rising price, because silver now looks like it's going to even outperform gold at this point. And due to position concentration, there'll be an opportunity for these agent bank pit managers to orchestrate some wash and rinse cycles along the way. And so what's happened is, really, when we look at these bank positions, they're actually, because they're long their own books, what they're doing is they're hedging, these shorts are hedging physical positions. Now, obviously, they're not one-to-one, but they're not naked short, which means that dips will be shallow. To explain this, it would be a good idea to address the gold-silver ratio part of the question. Now, most of these official derivative bets against silver have migrated into the ratio trade, where it's taken up to 120 ounces of silver to buy just 1 ounce of gold. And while this has now begun to unwind, it still requires over 90 ounces of silver to buy 1 ounce of gold. That is unsustainable. And the level of synthetic silver leverage is just not plausible. And while the natural ratio should be, say, 10 ounces of silver to buy 1 ounce of gold, valuing silver at current gold prices, liquidity providers figure an interim gap close to 35-1, which is pretty much what we saw at the end of the 2011 sell-off. But this inverse trade has massively expanded after the bullion banks came out of the gate last Thursday and involved selling some gold. Now, short term, as silver is left to run higher to begin to close the imbalance, obviously it's weighing on gold a little. And the activity we're seeing now is the usual volatility around CPI. Even though it was a miss, you get the usual gaming around those levels. So there we are, gold and silver as we are today. However, with China actively alchemizing this synthetic imbalance, buying both physical gold and silver, both gold and silver are in the process of securing higher physically supported stairsteps. Now, this is the core reason why the silver cartel is not naked short silver against a rising price. Now, notably, we're now evidencing silver being talked up, just as we experienced in gold when the bullion bank cartel moved to become fully Basel III compliant. Now, realizing the BRICS physical market dog was actually wagging, and they had built up very long in-house physical gold positions, if you remember, this is when the cartel of bullion banks began publicly talking up their long gold book. You remember, they were talking about 4,000, 3,500, 4,000, 4,500 even, at the expense of actually a dwindling volume of short speculator open interest left to actually short cover into. Collectively, these same bullion banks who have stealthily built very long in-house physical silver positions, they've started to come out publicly too, to also talk up their long silver book. There's going to be opportunities for the cartel to rinse out some low-hanging momentum longs because they're going to jump on board for the ride, and they're going to borrow silver from the bullion banks. So obviously there'll be some targeting of that along the way. But let's look at why those dips are actually going to be shallow. And in the past, we've seen huge discounts following through. Unlike commodities, it also trades as a foreign exchange cross, which means that the silver leg of the currency cross, because it's money, benchmarks the unallocated silver price at the fixes. It's money. So due to its unallocated nature, though, and we've seen up to 500-1 derivative flywheel being employed, the silver cartel has been able to historically cash settle, roll, and generally ring fence silver from ever breaking out to find its true supply-demand price. Now, anyone who missed the Bullion Bank Explained link in the last episode can find it. It is there, or there's also a link on that episode, but there's also, you can find it on the GATA website. Really important to understand. That is the cartel's strategy, which I think they wished they hadn't published that. However, just as we witnessed in gold after physical gold was offered at the fixes that became actually Basel III compliant. So remember, we're talking physical gold here. Is Basel III compliant? Has started to wag this COMEX derivative tail. And having built very long in-house physical silver long positions, the cartel, and I mean talking physical, this cartel of bullion banks have begun publicly talking up their long silver book. It's the commercials, the COTs, who've been on the long side of the options calls. Now, these are options calls that were not just bought, but sold by the speculators. And what the commercials did, they lend these to the chart painted specs who've just been acclimatized. It's going to really knock back down. We can guarantee 6 months, a month from now, 3 months from now, even a year out from now. Well, let's just place big bets against it, have a breaking out because it will come back to us. And now these market making bullion banks are now faced with two choices.